Good morning and welcome to today's morning report on Friday the 30th of January with me, Rich Perry, market analyst at Handtech Markets. The European trading session has got off to a mixed start really. The opening calls had been a little bit more positive than the markets are trading currently, but the FTSE has just fallen away slightly, just down back below negative, down 0.3%, and the DAX is just slightly higher at 0.2% up on the day. The rebound and the reason for markets potentially being positive today came on the fact that US had a nice rally into the close. The S&P 500 up 1% on the day, and that came as oil prices started to form a bit of support. You also had multi-year lows on the weekly jobless claims as well. So a decent recovery on Wall Street yesterday, but Forex charts generally tending to not really be reacting yet to this FOMC meeting, which is interesting. This dollar index, for example, just still really consolidating, not really doing a great deal on that dollar index in the reaction to that FOMC. But interestingly, yesterday we also had volatility, which was again sharply lower, so sharply higher on Wednesday, sharply lower again on Thursday, so back below 20 on the VIX, and that sort of reflects that improvement in the S&P 500. Lots going on today. We've had the Japanese CPI out overnight. That came in slightly weaker than expected. The core data coming in at 2.5%, down from 2.6%. That's the expected. That's the unadjusted data, whereas the adjusted data is more like 0.5%. So 0.5% is well below that 2% target from that the Bank of Japan has got. And what we've also got today is the Eurozone CPI. Now, that Eurozone data comes out at 10 o'clock. The expectation is for 0.5% negative. So deflation again, Eurozone falling further into deflation from the 0.2% negative last month. And it certainly looks like we're coming back towards the levels that we last saw back in 2009, when we hit a low of 0.6% negative into deflation on that number. Also, we've got today the big data, which is the advanced GDP for Q4 for the US. Now, GDP for the advanced stage came out at 3.5% last quarter, and then was subsequently revised higher to 5% in the end. So today's data of 3% expectation is slightly down from that advanced reading from last time. But it'll be interesting to see the reaction we get today. So 3% is still pretty good, pretty solid bout of growth there on an annualized basis for the US. So it'll be, as I said, interesting to see the reaction at 1:30 today. And also we've got the University of Michigan Consumer Sentiment. Now, I have to admit I did get the time slightly wrong on my morning report. 2:55 or 14:55 GMT I put, and for some reason it's now coming in at 3 o'clock. It's always been at 2:55 UK time, but for some reason today the calendars are telling me it's coming in at 3 o'clock. Anyway, I've not even done that expectation there. That's meant to be 98.2% expected there, which is basically in line with the with the flash data today. So there is a fair bit going on, but certainly the Eurozone CPI and advanced GDP are the key bits of data. So that takes me to my chart of the day, which is the Aussie dollar. Now, we've had a strong downside move again on the Aussie dollar 2 days in a row. We had a breakdown of this support, which was around 80.30. Had a breakdown earlier in the week, and that rebounded on Wednesday, but that rebound completely and utterly failed. We had a bearish outside day. We had a strong move to the downside yesterday, and that's broken again back below the low of 78.50, which had been an element of support. That now becomes a resistance. I'll show you on the intraday chart. That 78.50 there level is now the basis of resistance. That was the 80.30 level, which was hit pretty much bang on there on that rebound. 80.25 was the ultimate high on the rebound. So zooming in, it certainly looks like this is selling into strength. Any sort of rebound that you get, I think, is a selling into strength. Even now, the rebound that we've had overnight is just running out of steam, really. Momentum indicators, negative configuration, just unwinding. RSI back towards 40 area. hit sort of 45. So I think anything around the 78 figure level, between 78 figure and maybe 78.50, I think is a very good opportunity to sell if you can get it. Even then, the stochastics have already started to fall over, so it may not be that you get it at all. Now, on the daily chart, where does this go? Well, zoom out, zoom out, zoom out, and we're back towards this this level that we had back in 2009. Oh my, come on, Richard. 2009, which was 77 big figure, which was this reaction low here that we got in July, 77 bang on. So we are back at levels not seen since 2009, and it certainly looks like the strength of this sell-off may mean that we even come back towards this 66 figure level. That would be incredible. Sorry, 60 figure level. So that would be a big move to the downside. But at the moment, 77 figure is where we're sort of coming back towards. But to be honest, supports from 2009, you would argue whether they're relevant or not. Well, certainly you'd argue around this 72 figure level there's an element of an old neckline as well, so maybe that's something to watch out for. But certainly the Aussie is under pressure today, and it looks like it's open for further weakness, and selling into strength looks like the way to play it. So I wish you good luck in your trading on the Aussie today, and I will speak to you later. Thank you.